Question 1. Operational review demonstrates that an insurance company has implemented a blockchain solution for managing policyholder data and claims processing. The company is now facing the challenge of fulfilling its regulatory reporting obligations, as the data is stored and accessed in a decentralized, immutable ledger rather than a traditional centralized database. The company's compliance team is unsure how to accurately translate and present this blockchain-based data to meet the requirements of the Financial Conduct Authority, FCA, for its periodic regulatory returns. Which of the following approaches best addresses this regulatory reporting challenge? Option A. Develop an internal interpretation of how blockchain data should be reported and implement this new reporting methodology without consulting the FCA, assuming it meets the spirit of the regulations. Option B. Continue to report using the company's legacy reporting systems and processes, manually extracting and reformatting data to fit the traditional database structure without seeking external clarification. Option C. Proactively engage with the FCA to seek clarification and guidance on how to adapt existing reporting templates or develop new methods for reporting blockchain-based data, ensuring alignment with regulatory expectations. Option D. Suspend all regulatory reporting related to policyholder data and claims processing until the FCA issues explicit, detailed guidelines specifically for blockchain-based insurance reporting. The correct answer is C. Proactively engage with the FCA to seek clarification and guidance on how to adapt existing reporting templates or develop new methods for reporting blockchain-based data, ensuring alignment with regulatory expectations. Explanation. Scenario analysis. This scenario presents a professional challenge due to the evolving nature of blockchain technology and its integration into insurance operations, particularly concerning regulatory reporting. The core difficulty lies in interpreting and applying existing regulatory frameworks designed for traditional systems to a novel technological infrastructure. Professionals must exercise careful judgment to ensure compliance without stifling innovation or creating undue burdens. The need to balance technological advancement with regulatory adherence is paramount. Correct approach analysis. The correct approach involves proactively engaging with the relevant regulatory body to seek clarification and guidance on how blockchain-based data should be reported. This demonstrates a commitment to compliance and a responsible approach to adopting new technologies. By seeking official interpretation, the firm ensures its reporting methods align with regulatory expectations, mitigating the risk of non-compliance and potential penalties. This proactive engagement is crucial in a nascent regulatory landscape where specific guidance for blockchain reporting may not be explicitly detailed. Incorrect approaches analysis. One incorrect approach is to continue reporting using legacy systems and processes without adapting them to reflect the blockchain's data structure. This fails to accurately represent the insurance operations and could lead to misinterpretations by regulators, potentially resulting in compliance breaches. It ignores the fundamental shift in data management that blockchain introduces. Another incorrect approach is to unilaterally decide on a reporting method based on internal interpretation without seeking external validation. This carries a high risk of misinterpreting regulatory requirements, leading to inaccurate or incomplete reporting. It bypasses the essential step of ensuring alignment with the regulator's intent and expectations. A further incorrect approach is to delay reporting until specific blockchain reporting guidelines are issued. While caution is understandable, an indefinite delay can lead to significant reporting backlogs and potential breaches of reporting deadlines, incurring penalties and damaging the firm's reputation. This passive stance fails to address the immediate need for compliant reporting. Professional reasoning. Professionals facing this situation should adopt a structured decision-making process. First, thoroughly understand the existing regulatory reporting requirements and the capabilities of the blockchain system. Second, identify any ambiguities or gaps in how the blockchain data maps to current reporting mandates. Third, prioritize seeking clarification from the relevant regulatory authority, documenting all communications and guidance received. Fourth, implement reporting mechanisms that accurately reflect the blockchain's data while adhering to the regulator's clarified requirements. This iterative process of understanding, clarifying, and implementing ensures both technological advancement and regulatory compliance. Question 2. The efficiency study reveals that the blockchain insurance platform's transaction prioritization mechanism is causing significant delays for policyholder claims, potentially impacting regulatory compliance for timely payouts. Which of the following approaches best addresses this challenge, while adhering to the principles of blockchain integrity and insurance regulatory expectations? Option A. Arbitrarily prioritize internal operational transactions over all policyholder claims to streamline back-office processes. Option B. Create a separate off-chain system to manually prioritize and process high-value claims, bypassing the blockchain's native fee structure. Option C. Establish a fixed, low transaction fee for all users to ensure affordability and encourage widespread adoption, accepting potential delays as a trade-off. Option D. Implement a dynamic transaction fee system, where users can voluntarily pay higher fees for expedited processing of critical transactions, such as high-value claims. The correct answer is D. Implement a dynamic transaction fee system where users can voluntarily pay higher fees for expedited processing of critical transactions, such as high-value claims. Explanation: the efficiency study reveals that a blockchain-based insurance platform is experiencing significant delays in transaction finality, particularly for high-value claims processing. This is impacting customer satisfaction and potentially leading to regulatory scrutiny regarding timely claims settlement. The core issue stems from how transaction fees are structured and how the network prioritizes transactions. The professional challenge lies in balancing the need for network security and decentralization, which are inherent to blockchain, with the practical demands of an insurance business that requires speed and predictability for its policyholders. Mismanaging transaction prioritization can lead to accusations of unfair treatment of policyholders, operational inefficiencies, and non-compliance with insurance regulations that mandate prompt claims handling. The correct approach involves implementing a dynamic transaction fee mechanism that allows users to voluntarily pay higher fees for expedited processing of critical transactions, such as high-value claims. This approach aligns with the principle of network neutrality while providing a clear, market-driven method for prioritization. It is ethically sound as it offers a choice to users based on their needs and urgency, and it is regulatorily compliant as it does not inherently disadvantage any user group, but rather provides an optional service. This method respects the underlying blockchain consensus mechanism, which often uses fees to incentivize miners or validators to include transactions in blocks, thereby ensuring network security and decentralization. An incorrect approach would be to arbitrarily prioritize certain types of transactions, e.g., internal operational transactions, over customer claims without a transparent and justifiable mechanism. This could lead to regulatory breaches related to fair treatment of customers and prompt claims handling. Another incorrect approach is to fix transaction fees at a low level, which, while seemingly beneficial to users, can lead to network congestion and long delays, again risking regulatory noncompliance and customer dissatisfaction. Furthermore, attempting to bypass the fee-based prioritization system entirely by creating a separate, centralized queue for certain transactions would undermine the decentralized nature of the blockchain and introduce single points of failure, potentially violating the principles of blockchain integrity and security. Professionals should approach this by first understanding the specific regulatory requirements for claims processing speed within their operating jurisdiction. They should then analyze the technical capabilities of the chosen blockchain platform regarding transaction fee structures and prioritization. A risk-based assessment should be conducted to identify which types of transactions are most critical and would benefit most from expedited processing. Implementing a transparent, opt-in fee-based prioritization system, coupled with clear communication to users about the fee structure and its implications, represents a robust decision-making process. This ensures that operational efficiency is achieved without compromising regulatory compliance, ethical obligations, or the core principles of the blockchain technology. Question 3. Comparative studies suggest that while blockchain technology offers significant advantages in data integrity and auditability for insurance operations, its application to secure data storage and access control for sensitive policyholder information requires careful consideration of regulatory frameworks. For an insurance firm operating under UK regulations, which of the following approaches best balances the benefits of blockchain with the requirements of UK GDPR and the FCA Handbook regarding data protection and security? Option A. Employing blockchain solely for logging transaction events without verifying the integrity of the data being logged or implementing specific access controls for the logged information. Option B, implementing a hybrid model where sensitive personal data is stored off-chain in a secure, GDPR-compliant system, while the blockchain is used to store immutable hashes of the data and auditable access logs. Option C, utilizing a private blockchain for all sensitive policyholder data storage, relying on the inherent privacy of private blockchains for security. Option D, storing all sensitive policyholder data directly on a public, immutable blockchain to ensure maximum transparency and tamper evidence. The correct answer is D, storing all sensitive policyholder data directly on a public, immutable blockchain to ensure maximum transparency and tamper evidence. Explanation: scenario analysis. This scenario presents a professional challenge for an insurance professional operating within the UK regulatory framework, specifically concerning the use of blockchain for secure data storage and access control. The challenge lies in balancing the innovative potential of blockchain technology with the stringent data protection and privacy obligations mandated by UK law, particularly the UK GDPR and the Financial Conduct Authority (FCA) handbook. Ensuring that sensitive policyholder data is both securely stored and appropriately accessed, while maintaining compliance with regulatory requirements for data integrity, confidentiality, and accountability, requires careful judgment. The inherent immutability of blockchain, while beneficial for data integrity, also raises complex questions regarding the right to be forgotten and data rectification under UK GDPR. Correct approach analysis. The correct approach involves implementing a hybrid model where sensitive personal data is not directly stored on the blockchain. Instead, the blockchain is used to store immutable hashes or cryptographic proofs of the data, along with access control logs. The actual sensitive data would reside in a secure, GDPR-compliant off-chain storage solution. This approach is correct because it leverages blockchain strengths for tamper evidence and auditability without compromising the core principles of data protection. It allows for the verification of data integrity and access history through the blockchain, while the off-chain storage ensures that data can be managed in accordance with UK GDPR requirements, such as data subject rights, e.g., erasure, rectification, and data minimization. This aligns with FCA principles requiring firms to maintain adequate systems and controls to manage risks, including those related to data security and privacy. Incorrect approach is analysis. Storing all sensitive policyholder data directly on a public, immutable blockchain without any off-chain management is professionally unacceptable. This approach fails to comply with UK GDPR provisions on data subject rights, particularly the right to erasure and rectification. Once data is on an immutable ledger, it cannot be easily deleted or altered, creating a direct conflict with these fundamental rights. Furthermore, it raises significant concerns regarding data minimization and purpose limitation, as data stored permanently on a blockchain may be retained beyond its necessary use. Storing sensitive policyholder data on a private blockchain, but without robust, auditable access control mechanisms, is also professionally unacceptable. While a private blockchain offers more control than a public one, the absence of clear, verifiable access controls means that unauthorized access or data breaches could occur, violating the confidentiality principle of data protection. The FCA handbook mandates that firms have robust systems and controls to prevent unauthorized access to client data. Utilizing a blockchain solely for transaction logging without any mechanism to verify the integrity of the data being logged, or without considering the security of the data before it is hashed and logged, is also a flawed approach. The integrity of the blockchain record is only as good as the data it represents. If the initial data is compromised or inaccurate, the blockchain record, while immutable, will be an immutable record of compromised or inaccurate information, failing to meet the FCA's requirements for accurate and reliable record keeping. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and data protection principles when considering blockchain implementation. This involves 1. Understanding the specific regulatory obligations under UK GDPR and the FCA handbook concerning data storage, security, and data subject rights. 2. Evaluating the inherent characteristics of blockchain technology, immutability, transparency, decentralization, and how they align or conflict with these obligations. 3. Designing solutions that leverage the benefits of blockchain, e.g., for audit trails, integrity verification, while mitigating risks, particularly concerning sensitive personal data. This often means employing hybrid architectures. 4. Conducting thorough risk assessments to identify potential vulnerabilities and ensure appropriate security measures are in place for both on-chain and off-chain components. 5. Regularly reviewing and updating systems and processes to maintain compliance with evolving regulations and technological advancements. Question 4. Quality control measures reveal that an insurance company is exploring the use of verifiable data recorded on a blockchain to offer personalized insurance premiums. This data could include verified driving habits, health metrics from wearable devices, and energy consumption patterns. Which of the following approaches best aligns with regulatory and ethical requirements for risk assessment in this context? Option A. Offering significant premium reductions for individuals with demonstrably low-risk verifiable data, without establishing a clear, non-discriminatory underwriting framework to ensure that such reductions do not inadvertently create a market that excludes or disadvantages higher-risk individuals. Option B. Implementing a comprehensive data governance framework that ensures all verifiable data used for premium personalization is collected with explicit consent, processed transparently, and is subject to robust anonymization or pseudonymization techniques where applicable, with clear audit trails on the blockchain. Option C. Leveraging the immutability of blockchain data to automatically adjust premiums based on any verifiable data point, assuming that the inherent security of the ledger negates the need for explicit consent or purpose limitation. Option D. Utilizing sensitive verifiable health and behavioral data for premium calculations without implementing advanced security protocols or anonymization, relying on the assumption that the blockchain's distributed nature inherently protects this information. The correct answer is B. Implementing a comprehensive data governance framework that ensures all verifiable data used for premium personalization is collected with explicit consent, processed transparently, and is subject to robust anonymization or pseudonymization techniques where applicable, with clear audit trails on the blockchain. Explanation. This scenario presents a professional challenge because it requires balancing the potential benefits of personalized insurance premiums, enabled by verifiable data on a blockchain, with the stringent regulatory obligations concerning data privacy, fairness, and non-discrimination in the insurance sector. Professionals must navigate the complexities of data utilization while upholding consumer trust and adhering to legal frameworks. Careful judgment is required to ensure that the use of verifiable data for premium setting does not inadvertently lead to discriminatory practices or breaches of data protection laws. The correct approach involves implementing a robust data governance framework that ensures all verifiable data used for premium personalization is collected, stored, and processed in compliance with relevant data protection regulations. This includes obtaining explicit consent for data usage, anonymizing or pseudonymizing data where appropriate, and establishing clear audit trails on the blockchain to demonstrate compliance. The regulatory justification lies in adhering to principles of data minimization, purpose limitation, and transparency, which are fundamental to data protection laws. Ethically, this approach upholds fairness by ensuring that premium adjustments are based on objective, verifiable risk factors and not on protected characteristics, thereby preventing unfair discrimination. An incorrect approach that relies solely on the immutability of blockchain data, without considering consent and purpose limitation, would fail to meet regulatory requirements. This is because data protection laws often mandate that data subjects have control over their data, and that data is used only for the specific purposes for which it was collected. Another incorrect approach that prioritizes premium reduction for individuals with verifiable low-risk data, without a clear, non-discriminatory underwriting framework, could lead to adverse selection or market segmentation that disadvantages certain groups, violating principles of fairness and potentially specific anti-discrimination statutes. A third incorrect approach that uses sensitive verifiable data without adequate security measures or anonymization would directly contravene data privacy regulations, exposing individuals to risks of identity theft or misuse of personal information. Professionals should adopt a decision-making framework that begins with a thorough understanding of the applicable regulatory landscape, including data protection laws and insurance-specific regulations on underwriting and pricing. This should be followed by a risk assessment of the proposed data utilization, identifying potential ethical and regulatory pitfalls. Implementing a privacy by design and security by design approach, incorporating mechanisms for consent management, data anonymization, and transparent data usage policies is crucial. Regular audits and reviews of the data governance framework and its implementation on the blockchain are essential to ensure ongoing compliance and ethical practice. Question 5. Investigation of an insurance company's implementation of a blockchain-based claims processing system reveals that smart contracts are designed to automatically trigger claim payouts based on data feeds from external sources. The company is seeking to maximize the efficiency gains promised by blockchain and smart contracts. What is the most critical consideration for ensuring regulatory compliance and operational integrity in this implementation? Option A. Relying solely on the immutability of the blockchain to ensure the integrity of all transaction data and smart contract execution results, assuming that once recorded, the data is inherently accurate and compliant. Option B. Storing all sensitive policyholder data directly on the public blockchain to leverage its transparency and decentralization for data accessibility. Option C. Implementing a comprehensive off-chain data validation and smart contract outcome reconciliation process to verify the accuracy and compliance of all data inputs and transaction executions before and after they are recorded on the blockchain. Option D. Deploying the smart contract with the assumption that its logic is infallible and will not require any future updates or corrections, regardless of operational performance or discovered errors. Correct answer is C. Implementing a comprehensive off-chain data validation and smart contract outcome reconciliation process to verify the accuracy and compliance of all data inputs and transaction executions before and after they are recorded on the blockchain. Explanation. This scenario presents a professional challenge due to the inherent immutability and transparency of blockchain technology, coupled with the stringent regulatory requirements for data integrity and auditability in the insurance sector. Professionals must navigate the complexities of ensuring that smart contract execution, which is recorded as transactions on the blockchain, aligns with policy terms and regulatory mandates, while also safeguarding sensitive customer data. The challenge lies in balancing the benefits of blockchain's tamper-proof ledger with the need for compliance, particularly concerning data privacy and the accuracy of automated claims processing. The correct approach involves implementing a robust data validation and reconciliation process that occurs * before * transactions are committed to the blockchain and * after * smart contract execution. This includes rigorous testing of smart contract logic against policy wordings and regulatory requirements, and establishing an off-chain mechanism for verifying the accuracy of data fed into the smart contract and the outcomes of its execution. This approach ensures that only accurate and compliant data is processed and recorded, thereby maintaining the integrity of the blockchain record while adhering to regulatory obligations for data accuracy and auditability. It aligns with principles of good governance and risk management, ensuring that the automated processes do not lead to regulatory breaches or financial misstatements. An incorrect approach would be to solely rely on the immutability of the blockchain to guarantee the accuracy of transactions and smart contract outcomes. This fails to acknowledge that errors can be introduced at the data input stage or through flawed smart contract logic. Regulatory frameworks, such as those governing financial services and insurance, mandate that data used for policy administration and claims processing must be accurate and verifiable. Relying solely on blockchain's immutability without pre-validation and post-execution reconciliation risks recording erroneous or non-compliant transactions, which, while immutable, would still be incorrect and subject to regulatory scrutiny. Another incorrect approach is to store sensitive policyholder data directly on a public blockchain. This directly contravenes data privacy regulations, such as GDPR, if applicable to the exam's jurisdiction, or similar data protection laws, which require data minimization, purpose limitation, and secure storage of personal information. While blockchain offers transparency, this transparency must be managed to prevent unauthorized access or disclosure of sensitive data, necessitating the use of off-chain storage or privacy-preserving techniques for such information. A third incorrect approach is to assume that once a smart contract is deployed, its logic cannot be altered or corrected, even if errors are discovered. While blockchain's immutability applies to recorded transactions, the underlying smart contract code can often be updated or replaced through predefined governance mechanisms or by deploying a new version. Failing to have a process for addressing identified smart contract flaws would be a failure in professional duty to ensure the ongoing accuracy and compliance of automated processes. Professionals should adopt a decision-making framework that prioritizes a trust but verify approach. This involves understanding the capabilities and limitations of blockchain technology, thoroughly assessing regulatory requirements, and designing processes that integrate blockchain strengths with necessary off-chain controls for data validation, smart contract logic verification, and privacy protection. Continuous monitoring and auditing of both on-chain and off-chain components are crucial for maintaining compliance and operational integrity. Question 6. The evaluation methodology shows that a new insurance product requires a blockchain solution to manage policy issuance, claims processing, and reinsurance data sharing. Considering the stringent data privacy requirements under UK GDPR and the regulatory oversight by the Financial Conduct Authority, FCA, which type of blockchain would best balance transparency, security, and compliance for this specific scenario? Option A, a private blockchain allowing controlled access for authorized participants and robust data privacy. Option B, a consortium blockchain where a select group of insurers and reinsurers jointly manage the ledger with predefined access controls. Option C, a public blockchain offering maximum transparency and decentralization for all transactions. Option D, a hybrid blockchain combining elements of public and private ledgers without a defined governance model for the private components. The correct answer is A, a private blockchain allowing controlled access for authorized participants and robust data privacy. Explanation. The evaluation methodology shows that a blockchain solution is being considered for a new insurance product. The challenge lies in selecting the most appropriate blockchain type that balances the need for transparency and immutability with regulatory compliance, data privacy, and operational efficiency within the UK's financial services landscape, particularly as governed by the Financial Conduct Authority, FCA, and relevant data protection laws like the UK GDPR. Professionals must navigate the trade-offs between the open nature of public blockchains and the controlled environments of private or consortium models. The correct approach involves selecting a private or consortium blockchain. This is because insurance operations, especially those involving sensitive customer data and complex claims processing, require a controlled environment. A private or consortium blockchain allows for permissioned access, ensuring that only authorized participants, e.g., the insurer, reinsurers, regulators, and potentially trusted third-party service providers, can validate transactions and access data. This aligns with the FCA's focus on consumer protection and market integrity, as well as the UK GDPR requirements for data minimization and security. The ability to control who participates and what data is shared is paramount for maintaining confidentiality and complying with regulatory obligations regarding data privacy and security. Furthermore, these models typically offer higher transaction speeds and scalability, which are crucial for efficient insurance operations. An incorrect approach would be to select a public blockchain. While offering maximum transparency and decentralization, public blockchains are generally unsuitable for regulated insurance operations due to the inherent lack of privacy for sensitive customer and commercial data. The immutability and transparency of a public ledger would likely conflict with UK GDPR requirements for data protection and the FCA's expectations for secure data handling. Furthermore, the potential for unknown participants and the slower transaction speeds associated with many public blockchains could hinder operational efficiency and introduce unacceptable risks. Another incorrect approach would be to select a hybrid blockchain without a clear understanding of its specific implementation and governance. While hybrid models aim to combine the benefits of public and private blockchains, their effectiveness hinges on the precise architecture and how data is partitioned and accessed. A poorly designed hybrid model could inadvertently expose sensitive data or fail to provide the necessary control and auditability required by regulators, leading to compliance breaches. The lack of a defined governance structure for the private components of a hybrid model could also create ambiguity regarding accountability and regulatory oversight. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and risk management. This involves 1. Identifying all relevant regulatory requirements, e.g., FCA principles, UK GDPR, specific insurance regulations. 2. Assessing the data sensitivity and privacy needs of the insurance product. 3. Evaluating the operational requirements for speed, scalability, and control. And 4. Mapping these requirements against the characteristics of different blockchain types. A thorough risk assessment of each blockchain type's suitability for the specific use case, considering potential regulatory breaches and data security vulnerabilities, is essential before making a selection. Question 7. Stakeholder feedback indicates a growing interest in leveraging blockchain technology to enhance efficiency across the insurance value chain. Considering the regulatory framework for insurance professionals in the UK, which of the following approaches best balances technological innovation with compliance requirements for underwriting, claims processing, and policy administration? Option A. Prioritizing the use of blockchain for internal cost reduction and policy administration by digitizing existing paper-based processes without verifying the blockchain's compliance with GDPR and other data protection regulations. Option B. Implementing a permission blockchain for immutable record-keeping in underwriting, utilizing smart contracts for automated claims payouts based on predefined triggers, and employing blockchain for secure, auditable policy lifecycle management. Option C. Adopting a public, decentralized blockchain for all policyholder data to maximize transparency, and using its inherent immutability to automatically reject any claims that deviate from initial policy terms. Option D. Deploying a blockchain solution for claims processing that relies on oracles for external data, without establishing clear regulatory oversight or auditability mechanisms for the oracle's data sources. The correct answer is B. Implementing a permission blockchain for immutable record-keeping in underwriting, utilizing smart contracts for automated claims payouts based on predefined triggers, and employing blockchain for secure, auditable policy lifecycle management. Explanation. This scenario presents a professional challenge because it requires balancing the potential benefits of blockchain technology in streamlining insurance processes with the imperative to adhere strictly to the regulatory framework governing the insurance industry. Professionals must navigate the complexities of integrating new technologies while ensuring compliance with established laws and guidelines, particularly concerning data integrity, consumer protection, and operational efficiency. The core difficulty lies in identifying which blockchain applications genuinely enhance the insurance value chain, underwriting, claims processing, policy administration, without introducing new regulatory risks or failing to meet existing obligations. The correct approach involves a thorough assessment of how specific blockchain functionalities can be applied to improve underwriting accuracy, accelerate claims processing, and enhance policy administration, all while demonstrably meeting or exceeding current regulatory standards for data security, transparency, and auditability. This approach is correct because it prioritizes regulatory compliance and demonstrable value creation. For instance, using blockchain for immutable record-keeping in underwriting can enhance data integrity, a key regulatory concern. Similarly, smart contracts for automated claims payouts, if designed and implemented within regulatory parameters, can improve efficiency and reduce disputes, aligning with principles of fair treatment of customers. The justification lies in the proactive integration of technology that serves both business objectives and regulatory mandates, ensuring that innovation does not come at the expense of compliance. An incorrect approach would be to adopt blockchain solutions solely based on their perceived technological novelty or potential for disruption, without a rigorous evaluation of their alignment with existing regulatory requirements. For example, implementing a blockchain for claims processing that lacks robust mechanisms for dispute resolution or fails to provide clear audit trails for regulatory review would be a significant ethical and regulatory failure. Another incorrect approach would be to focus on blockchain's potential for cost reduction in policy administration, without ensuring that the technology maintains the necessary levels of data privacy and security mandated by regulations, potentially exposing sensitive customer information. These approaches fail because they prioritize innovation or efficiency over fundamental regulatory obligations, risking noncompliance, reputational damage, and potential penalties. Professional decision-making in such situations requires a structured, risk-based approach. This involves 1. Understanding the specific regulatory landscape relevant to the insurance sector in the designated jurisdiction. 2. Identifying key pain points and inefficiencies within the insurance value chain. 3. Evaluating potential blockchain solutions against these pain points, with a primary filter being regulatory compliance and data integrity. 4. Conducting thorough due diligence on the technology's security, auditability, and compatibility with existing regulatory reporting requirements. 5. Piloting and testing solutions in a controlled environment to assess both operational benefits and regulatory adherence before full-scale implementation. This methodical process ensures that technological advancements are integrated responsibly and ethically, safeguarding both the organization and its stakeholders. Question 8. The review process indicates that a blockchain-based insurance platform operating within the UK is considering implementing a public key infrastructure, PKI, to manage digital identities and secure transactions. The platform's technical team has proposed 3 potential approaches for establishing the certificate authority, CA function. Which of the following approaches best aligns with the regulatory framework and best practices for a regulated financial services entity in the UK? Option A. Self-issuing all digital certificates internally without external accreditation, relying solely on the platform's internal security protocols. Option B. Utilizing a certificate authority that is regulated, but without a clearly defined service-level agreement or liability framework for certificate issuance and management. Option C. Partnering with a certificate authority based in a non-UK jurisdiction that claims adherence to international security standards, but lacks specific UK regulatory accreditation. Option D. Engaging a certificate authority that is accredited and regulated under the UK's eIDAS framework, or a similarly recognized UK regulatory body, ensuring clear delineation of responsibilities and adherence to data protection regulations. Correct answer is D. Engaging a certificate authority that is accredited and regulated under the UK's eIDAS framework, or a similarly recognized UK regulatory body, ensuring clear delineation of responsibilities and adherence to data protection regulations. Explanation. The scenario presents a professional challenge in implementing a public key infrastructure, PKI, for a blockchain-based insurance platform within the UK regulatory framework, specifically concerning the role and responsibilities of certificate authorities, CA. The challenge lies in ensuring that the chosen PKI implementation aligns with the principles of data integrity, security, and regulatory compliance as outlined by UK financial services regulations and relevant data protection laws. Professionals must navigate the complexities of digital identity, trust establishment, and the legal standing of digital certificates in a regulated environment. The correct approach involves establishing a PKI where the certificate authority is a regulated entity, such as one authorized under the UK's eIDAS regulation or a similarly accredited body, to issue and manage digital certificates. This ensures that the CA operates under a robust legal and regulatory framework, providing a high degree of assurance regarding the identity of the certificate holder and the integrity of the issued certificates. This aligns with the UK's approach to digital trust services, where accredited CAs are essential for establishing verifiable digital identities and ensuring the authenticity of transactions and data on distributed ledgers. The regulatory justification stems from the need for a trusted third party to vouch for the integrity of digital identities and cryptographic keys, which is fundamental for secure and compliant operations in the insurance sector. This approach directly supports the integrity and non-repudiation requirements crucial for insurance contracts and claims processing. An incorrect approach would be to self-issue certificates without adhering to a recognized accreditation or regulatory oversight. This bypasses the established trust mechanisms and regulatory safeguards designed to protect against fraudulent issuance and ensure the reliability of digital identities. From a regulatory perspective, this would likely fail to meet the requirements for secure data handling and identity verification mandated by the Financial Conduct Authority, FCA, and the Information Commissioner's Office, ICO, under GDPR. Such an approach would undermine the legal standing of the digital certificates, making them unreliable for critical insurance functions, and potentially exposing the platform to significant legal and reputational risks. Another incorrect approach would be to rely on a CA that is not regulated or accredited within the UK, even if it operates in another jurisdiction with seemingly robust standards. While international standards exist, the specific legal and regulatory landscape of the UK is paramount for compliance. The UK's approach to digital signatures and trust services is often tied to specific national or EU-derived regulations, like eIDAS, and a non-UK accredited CA might not meet the stringent requirements for legal recognition and evidentiary weight within the UK legal system. This could render the digital certificates issued by such a CA insufficient for regulatory purposes, particularly in dispute resolution or audit scenarios. A further incorrect approach would be to implement a PKI without clearly defining the responsibilities and liabilities of the certificate authority, even if it is a regulated entity. This lack of clarity can lead to operational gaps and potential breaches of trust. Regulatory frameworks often stipulate clear roles, responsibilities, and recourse mechanisms for CAs. Failing to define these aspects adequately, even with a regulated CA, can lead to non-compliance with operational standards and a weakened trust model, which is unacceptable in a regulated financial services environment. Professionals should adopt a decision-making process that prioritizes regulatory compliance and robust trust models. This involves thoroughly researching and selecting a CA that is accredited and regulated within the target jurisdiction, in this case, the UK. The selection process should also include a detailed review of the CA's operational policies, security practices, and adherence to relevant legal frameworks, such as eIDAS and data protection laws. Furthermore, clear contractual agreements outlining the responsibilities and liabilities of all parties involved in the PKI implementation are essential. Question 9. Market research demonstrates a growing interest among policyholders for greater control over their personal data and a more streamlined digital experience. An insurance company is exploring the implementation of a blockchain-based digital identity management system for its policyholders. Considering the regulatory framework for insurance professionals in the UK, which of the following approaches to implementing this system would be most professionally sound and compliant? Option A. Implement a decentralized digital identity solution where policyholders control their verifiable credentials, with the insurer only having access to verified attributes necessary for policy administration, and ensuring all data handling adheres to UK GDPR principles and FCA guidance on data security and consumer protection. Option B. Deploy a digital identity solution that leverages existing third-party identity providers without conducting independent due diligence on their data handling practices or ensuring their compliance with UK data protection regulations. Option C. Utilize a public, permissionless blockchain to store encrypted policyholder identity data, relying solely on cryptographic hashing for verification without establishing clear data ownership or consent mechanisms. Option D. Develop a permissioned blockchain where the insurer maintains full control over all policyholder identity data, allowing for rapid verification and integration with existing internal systems, with minimal policyholder input on data sharing. The correct answer is A. Implement a decentralized digital identity solution where policyholders control their verifiable credentials, with the insurer only having access to verified attributes necessary for policy administration, and ensuring all data handling adheres to UK GDPR principles and FCA guidance on data security and consumer protection. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging innovative blockchain technology for enhanced policyholder digital identity management and the stringent regulatory requirements governing data privacy, security, and consumer protection within the insurance sector. The need to balance technological advancement with compliance necessitates careful consideration of legal frameworks, ethical obligations, and the potential impact on policyholder trust. The correct approach involves implementing a decentralized digital identity solution that prioritizes policyholder consent and control over their personal data, while adhering to the principles of data minimization and robust security measures mandated by relevant regulations. This approach is professionally sound because it aligns with the spirit and letter of data protection laws, such as the UK's General Data Protection Regulation, UK GDPR, and the Financial Conduct Authority's, FCA, principles. Specifically, it upholds the policyholder's right to privacy, ensures transparency in data processing, and establishes clear accountability for data handling. By utilizing blockchain's immutability and cryptographic security, it can enhance data integrity and reduce the risk of unauthorized access or modification, thereby meeting regulatory expectations for data security. An incorrect approach that centralizes policyholder identity data on a single, permissioned blockchain managed solely by the insurer would be professionally unacceptable. This fails to adequately address the risk of a single point of failure and potential for data breaches, which contravenes regulatory requirements for robust data security and risk management. Furthermore, it may not fully empower policyholders with control over their data, potentially violating principles of consent and data subject rights. Another incorrect approach that relies on self-sovereign identity solutions without clear mechanisms for data verification and compliance with anti-money laundering (AML) and Know Your Customer (KIC) regulations would also be professionally unsound. While self-sovereign identity promotes user control, insurers have a regulatory obligation to verify identities for fraud prevention and regulatory compliance. A solution that bypasses these essential checks, even if technologically advanced, would expose the insurer to significant regulatory penalties and reputational damage. Finally, an approach that prioritizes speed of implementation over thorough due diligence on the blockchain platform's security, privacy features, and regulatory compliance would be a critical professional failure. This demonstrates a disregard for the fundamental principles of responsible innovation and could lead to breaches of data protection laws and consumer trust, resulting in severe consequences. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the specific regulatory landscape applicable to their jurisdiction, e.g., UK GDPR, FCA Handbook. This should be followed by a thorough risk assessment of any proposed blockchain solution, evaluating its impact on data privacy, security, and compliance with KYC/AML requirements. Prioritizing solutions that offer granular control to policyholders, ensure transparency, and demonstrate robust security protocols is paramount. Continuous engagement with legal and compliance teams throughout the implementation process is essential to ensure ongoing adherence to evolving regulatory expectations. Question 10. Assessment of the ethical and regulatory implications for an insurance company considering implementing a blockchain-based system for enhanced fraud detection, which would involve sharing anonymized claims data across a consortium of insurers. The company's internal legal team has advised that while the data would be anonymized, the process might not be entirely irreversible if combined with external datasets. The company has not yet consulted with policyholders about this potential data usage. What is the most ethically and regulatorily sound approach? Option A. Delay the blockchain implementation until a definitive legal opinion confirms that the anonymization process is absolutely irreversible and compliant with all data protection laws, even if this means foregoing potential fraud detection benefits in the interim. Option B. Proceed with the blockchain implementation, ensuring the data is anonymized to the highest possible standard, and inform policyholders of the data usage through updated privacy notices. Option C. Implement the blockchain solution using the proposed anonymization technique and rely on the fact that the data is not directly identifiable to policyholders. Option D. Obtain explicit, informed consent from all policyholders whose data might be used on the blockchain for fraud detection purposes, clearly explaining the nature of the data sharing and the benefits of fraud prevention. The correct answer is B. Proceed with the blockchain implementation, ensuring the data is anonymized to the highest possible standard, and inform policyholders of the data usage through updated privacy notices. Explanation. This scenario presents a professional challenge because it requires balancing the potential benefits of blockchain technology for fraud detection with the ethical obligations of data privacy and consent. The insurance professional must navigate the complexities of data sharing and its implications for policyholders, ensuring that any implementation adheres strictly to the regulatory framework governing data protection and insurance practices. The correct approach involves obtaining explicit, informed consent from policyholders before their data is utilized on a blockchain for fraud detection. This aligns with the principles of data privacy and consumer protection mandated by relevant regulations. By seeking consent, the insurer demonstrates transparency and respects the individual's right to control their personal information. This proactive approach builds trust and ensures compliance with legal and ethical standards, mitigating the risk of regulatory penalties and reputational damage. An incorrect approach would be to proceed with data utilization on the blockchain without obtaining explicit consent, relying solely on the purported benefits of enhanced fraud detection. This would violate data protection principles, potentially breaching regulations that require consent for processing personal data, especially sensitive information often found in insurance contexts. Such an action could lead to significant fines, legal challenges, and a severe erosion of customer trust. Another incorrect approach would be to anonymize data to a degree that it is no longer personally identifiable, but without considering whether the anonymization process is truly irreversible and robust enough to prevent re-identification. While anonymization can be a valid strategy, the regulatory definition of anonymized data is stringent, and a failure to meet these standards, even with good intentions, can still result in non-compliance if re-identification is possible. A third incorrect approach would be to implement the blockchain solution and then inform policyholders of its use, hoping for passive acceptance. This reactive approach fails to meet the requirement for proactive consent and transparency. It places the burden on the policyholder to object rather than on the insurer to obtain permission, which is contrary to ethical data handling practices and most data protection laws. The professional decision-making process should involve a thorough understanding of the applicable regulatory framework, particularly concerning data privacy and insurance operations. Before implementing any new technology like blockchain for fraud detection, a comprehensive risk assessment should be conducted, focusing on data protection, consent mechanisms, and potential ethical implications. Consultation with legal and compliance experts is crucial to ensure that all proposed actions are compliant and ethically sound. Transparency with policyholders, through clear communication and obtaining informed consent, should be a cornerstone of the implementation strategy. Question 11. Upon reviewing the potential for blockchain-based payment protocols to streamline international insurance claims settlement, an insurance professional is considering the use of Ripple XRP for facilitating cross-border payouts. Within the regulatory framework of the blockchain for insurance professionals' certificate exam, which of the following approaches best reflects a compliant and professionally sound decision-making process regarding the integration of Ripple XRP? Option A. Proceed with integrating Ripple XRP for international claims payouts based on its perceived technological efficiency and widespread adoption in other financial sectors, without a thorough review of its specific regulatory status and compliance requirements within the exam's jurisdiction for insurance professionals. Option B. Conduct a detailed analysis of Ripple XRP and its associated payment protocol against the specific definitions and guidelines provided by the relevant financial conduct authority in the exam's jurisdiction, focusing on its classification as a payment instrument or utility token for approved financial services, and proceed only if compliant with these specific regulations. Option C. Treat Ripple XRP as a security and implement all associated stringent compliance measures for securities trading and handling, even if the relevant financial conduct authority has not explicitly classified it as such for payment protocol use within the insurance sector. Option D. Assume Ripple XRP is a speculative cryptocurrency similar to Bitcoin and apply general cryptocurrency regulations to its use for insurance payments, without specific regard for its distinct payment protocol design or jurisdiction-specific financial service regulations. The correct answer is B. Conduct a detailed analysis of Ripple XRP and its associated payment protocol against the specific definitions and guidelines provided by the relevant financial conduct authority in the exam's jurisdiction, focusing on its classification as a payment instrument or utility token for approved financial services, and proceed only if compliant with these specific regulations. Explanation. This scenario presents a professional challenge for insurance professionals due to the evolving nature of blockchain technology and its integration into financial services, specifically concerning payment protocols like Ripple XRP. The challenge lies in discerning the regulatory status and implications of such technologies within the existing insurance framework, particularly when considering their use for cross-border payments or claims settlement. Professionals must navigate the complexities of whether XRP is primarily a payment mechanism or a security, as this distinction has significant regulatory and compliance ramifications under the specified exam jurisdictions framework. Careful judgment is required to ensure adherence to all applicable laws and guidelines, avoiding potential breaches that could lead to financial penalties or reputational damage. The correct approach involves a thorough assessment of Ripple XRP and its associated protocols against the specific regulatory definitions and guidelines applicable to the insurance industry within the exam's jurisdiction. This means understanding how the relevant Financial Conduct Authority or regulatory body classifies XRP and its use cases. If the jurisdiction's regulations clearly define XRP as a payment instrument or utility token with specific permissible uses within financial services, then leveraging it for approved payment functions, such as facilitating international claims payouts, would be compliant. This approach prioritizes regulatory clarity and adherence to established frameworks, ensuring that any use of XRP aligns with the spirit and letter of the law, thereby protecting both the insurer and the insured. An incorrect approach would be to assume XRP is solely a cryptocurrency akin to Bitcoin, without considering its specific design as a payment protocol and the potential for different regulatory treatments. This could lead to misclassification and noncompliance if the jurisdiction's regulators have specific rules for payment systems that differ from those for speculative digital assets. Another incorrect approach would be to treat XRP as a security without a clear regulatory determination to that effect within the exam's jurisdiction. This could lead to unnecessary compliance burdens and restrictions on its use, potentially hindering efficient claims processing. Furthermore, ignoring the specific regulatory guidance on digital assets and blockchain technology within the insurance sector of the specified jurisdiction would be a critical failure. This would mean operating without a proper understanding of the legal landscape, exposing the firm to significant risks. Professionals should adopt a decision-making framework that begins with identifying the specific regulatory jurisdiction governing their operations. Next, they must research the official stance and guidance from the relevant regulatory bodies concerning blockchain technology, digital assets, and payment protocols like Ripple XRP. This research should focus on how these technologies are classified and what specific rules apply to their use within the insurance industry. If there is ambiguity, professionals should seek clarification from legal and compliance departments or directly from the regulators. Finally, any proposed use of XRP or similar technologies must be subject to a comprehensive risk assessment and compliance review to ensure it aligns with all legal, ethical, and operational requirements. Question 12. The assessment process reveals that an insurance company is exploring the use of blockchain technology to streamline claims processing and enhance data security. The company's legal and compliance team is tasked with ensuring that this implementation adheres strictly to the regulatory framework for the insurance sector within the United Kingdom, as governed by the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA. Which of the following approaches best ensures regulatory compliance for this blockchain initiative? Option A. Implementing the blockchain solution after a comprehensive review of FCA and PRA guidelines on digital assets and distributed ledger technology, and seeking explicit guidance on data handling and consumer protection within the context of the proposed blockchain application. Option B. Proceeding with the blockchain implementation based on the assumption that existing insurance regulations adequately cover the use of new technologies, and addressing any potential regulatory issues only if they arise post-launch. Option C. Adopting a blockchain solution that is compliant with general data protection principles, but without specific consultation with the FCA or PRA regarding its application within the regulated insurance sector. Option D. Prioritizing the technical efficiency and cost-saving benefits of the blockchain solution, with a secondary consideration for regulatory compliance, to be addressed through a post-implementation audit. The correct answer is A. Implementing the blockchain solution after a comprehensive review of FCA and PRA guidelines on digital assets and distributed ledger technology, and seeking explicit guidance on data handling and consumer protection within the context of the proposed blockchain application. Explanation. The assessment process reveals a common challenge in the insurance industry when adopting new technologies like blockchain, ensuring regulatory compliance across diverse operational areas. Professionals must navigate the intersection of technological innovation and established legal frameworks, which often lag behind. This scenario is professionally challenging because it requires a proactive and informed approach to regulatory adherence, rather than a reactive one. Misinterpreting or overlooking specific regulatory requirements can lead to significant legal repercussions, reputational damage, and operational disruption. Careful judgment is required to balance the potential benefits of blockchain with the imperative to comply with all applicable laws and guidelines. The correct approach involves a thorough understanding of the specific regulatory landscape governing blockchain use in insurance within the designated jurisdiction. This means identifying all relevant statutes, directives, and guidance from regulatory bodies that pertain to data privacy, consumer protection, anti-money laundering (AML), and the general conduct of insurance business. Implementing blockchain solutions must be done in a manner that demonstrably meets these requirements, potentially through robust data governance, transparent transaction logging, and secure identity verification mechanisms. This approach is right because it prioritizes adherence to the law, safeguarding both the insurer and its policyholders, and building trust in the technology. Regulatory justification stems from the fundamental principle that all financial services, including those leveraging new technologies, must operate within the established legal and ethical boundaries designed to protect market integrity and consumers. An incorrect approach that focuses solely on the technological advantages of blockchain, without considering regulatory implications, is professionally unacceptable. This failure stems from a disregard for legal obligations, potentially leading to breaches of data protection laws, e.g., GDPR if applicable to the jurisdiction, or equivalent local legislation, or consumer protection regulations. Another incorrect approach that prioritizes speed to market over comprehensive compliance is equally flawed. This haste can result in overlooking critical regulatory hurdles, such as those related to Know Your Customer (KYC) or AML requirements, exposing the firm to fines and sanctions. A third incorrect approach that assumes existing regulations are sufficient without specific adaptation for blockchain technology is also problematic. This can lead to a false sense of security, as regulators often issue specific guidance or interpret existing rules in light of new technological applications. The professional decision-making process for similar situations should involve a multidisciplinary team including legal counsel, compliance officers, and technology experts. This team should conduct a comprehensive regulatory impact assessment for any proposed blockchain implementation. They should actively engage with regulatory bodies to seek clarification and ensure alignment. Furthermore, a robust risk management framework should be in place to identify, assess, and mitigate regulatory risks associated with blockchain adoption. Continuous monitoring and adaptation to evolving regulatory landscapes are also crucial. Question 13. Performance analysis shows that a UK-based insurance firm is exploring the use of a permissioned blockchain for managing claims processing and policyholder data. The firm is particularly concerned about ensuring compliance with UK data protection laws and FCA regulations. Which of the following approaches best balances the benefits of blockchain technology with these regulatory requirements? Option A. Utilizing a permissioned blockchain with minimal access controls, allowing any participant to view and query all recorded policyholder information to facilitate rapid data sharing and analysis. Option B. Deploying a permissioned blockchain where all policyholder data, including personal details and claim specifics, is directly recorded and immutably stored on the ledger for maximum transparency among all network participants. Option C. Implementing a permissioned blockchain where sensitive policyholder data is encrypted and stored off-chain, with only immutable hashes and transaction metadata recorded on the blockchain, coupled with strict access controls for authorized participants. Option D. Adopting a permissioned blockchain solution that relies solely on participant self-governance for data privacy, without implementing specific technical controls or encryption for sensitive information on the ledger. The correct answer is C. Implementing a permissioned blockchain where sensitive policyholder data is encrypted and stored off-chain, with only immutable hashes and transaction metadata recorded on the blockchain, coupled with strict access controls for authorized participants. Explanation. This scenario presents a professional challenge for an insurance firm considering a permissioned blockchain for enterprise solutions, specifically concerning data privacy and regulatory compliance within the UK's financial services landscape. The firm must balance the benefits of blockchain technology, such as enhanced transparency and efficiency, with the stringent data protection requirements mandated by regulations like the UK GDPR and the Financial Conduct Authority (FCA) handbook. The core difficulty lies in ensuring that the distributed ledger, even in a permissioned environment, does not inadvertently compromise sensitive customer data or violate principles of data minimization and purpose limitation. Careful judgment is required to select a blockchain architecture and governance model that aligns with these regulatory obligations. The correct approach involves implementing a permissioned blockchain solution that prioritizes data privacy through robust encryption, access controls, and potentially off-chain data storage for sensitive personal information, while maintaining an immutable audit trail of transactions on the blockchain. This aligns with the principles of data protection by design and by default, as required by UK GDPR. The FCA handbook also emphasizes the importance of robust governance, risk management, and the protection of client assets and data. A solution that incorporates these elements, such as using zero-knowledge proofs or anonymization techniques for on-chain data where appropriate, and clearly defining data access rights and responsibilities for participants, demonstrates a commitment to regulatory compliance and ethical data handling. This approach ensures that the benefits of blockchain are realized without compromising the firm's legal and ethical obligations. An incorrect approach would be to deploy a permissioned blockchain where all transaction data, including sensitive personal policyholder information, is stored directly and immutably on the ledger without adequate anonymization or encryption. This would likely violate the principles of data minimization and purpose limitation under UK GDPR, as well as potentially contravene FCA requirements regarding the secure handling of client data. Another incorrect approach would be to adopt a permissioned blockchain with overly broad participant access rights, allowing unauthorized entities to view or interact with sensitive data, thereby failing to uphold confidentiality and security obligations. Furthermore, a failure to establish clear governance mechanisms for data management and dispute resolution on the blockchain would also be a significant regulatory and ethical failing, as it would leave the firm vulnerable to non-compliance and operational risks. Professionals should adopt a decision-making framework that begins with a thorough understanding of the specific regulatory requirements applicable to their jurisdiction, in this case, the UK. This involves consulting relevant legislation, UK GDPR, regulatory guidance, FCA handbook, and industry best practices. Before selecting a blockchain solution, a comprehensive risk assessment should be conducted, focusing on data privacy, security, and operational resilience. The chosen solution must then be designed and implemented with data protection principles embedded from the outset. Ongoing monitoring and auditing of the blockchain's performance and compliance are crucial to ensure continued adherence to regulatory standards and ethical considerations. Question 14. Implementation of blockchain technology in insurance claims processing presents several potential approaches. Which of the following approaches best aligns with the regulatory framework for blockchain in insurance, prioritizing compliance and ethical considerations? Option A. Deploying a blockchain application primarily based on its widespread adoption in other financial sectors, assuming its inherent security features will satisfy insurance regulatory requirements. Option B. Implementing a blockchain solution that offers significant cost reductions through automated claims verification via smart contracts, with minimal consideration for data privacy regulations beyond basic encryption. Option C. Utilizing a blockchain solution that focuses on speed of transaction settlement, with the understanding that regulatory compliance can be addressed through post-implementation adjustments and manual oversight. Option D. Adopting a decentralized blockchain platform that allows for immutable record-keeping of all claims data, ensuring transparency and auditability, while also incorporating robust data anonymization and consent management protocols in line with data protection laws. The correct answer is B. Implementing a blockchain solution that offers significant cost reductions through automated claims verification via smart contracts, with minimal consideration for data privacy regulations beyond basic encryption. Explanation: scenario analysis. This scenario presents a professional challenge for insurance professionals by requiring them to evaluate the practical and regulatory implications of adopting different blockchain applications for claims processing. The core difficulty lies in balancing the potential benefits of efficiency and transparency offered by blockchain with the stringent regulatory requirements governing data privacy, security, and the integrity of insurance operations within the specified jurisdiction. Professionals must exercise careful judgment to ensure any chosen blockchain solution aligns with existing legal frameworks and ethical obligations, particularly concerning customer data and regulatory reporting. Correct approach analysis. The correct approach involves a comprehensive assessment of each blockchain application's alignment with the regulatory framework for blockchain in insurance within the specified jurisdiction. This includes scrutinizing how each application handles data immutability, smart contract execution, and the potential for regulatory audit trails. A key consideration is ensuring that the chosen application adheres to data protection laws, such as GDPR, if applicable to the jurisdiction, by implementing appropriate consent mechanisms and data anonymization techniques where necessary. Furthermore, the approach must verify that the smart contracts are auditable, transparent, and comply with insurance contract law, ensuring fair and accurate claims settlement. This meticulous alignment with regulatory mandates and ethical principles is paramount for lawful and trustworthy implementation. Incorrect approaches analysis. Focusing solely on the potential cost savings of a blockchain application without a thorough regulatory review is an incorrect approach. This failure neglects the fundamental obligation to comply with insurance regulations, which often mandate specific data handling, security, and reporting standards. Such an approach risks significant legal penalties, reputational damage, and loss of customer trust if the chosen solution violates privacy laws or fails to meet auditability requirements. Prioritizing the perceived technological superiority of a blockchain application over its regulatory compliance is also an incorrect approach. While innovation is encouraged, it cannot supersede legal obligations. A solution that is technically advanced but does not meet the jurisdiction's requirements for data integrity, dispute resolution, or consumer protection is professionally unacceptable and legally untenable. Adopting a blockchain application based on its popularity or adoption by other industries without verifying its suitability for the specific insurance regulatory environment is another incorrect approach. Each industry and jurisdiction has unique regulatory nuances. What works in one context may not be compliant or effective in another, particularly in a regulated sector like insurance. This oversight can lead to non-compliance with insurance-specific laws and guidelines. Professional reasoning. Professionals should adopt a risk-based approach, beginning with a thorough understanding of the relevant regulatory framework for blockchain in insurance within their jurisdiction. This involves identifying all applicable laws, guidelines, and supervisory expectations. When evaluating blockchain applications, the decision-making process should prioritize regulatory compliance and data security as non-negotiable prerequisites. A structured due diligence process should be established, encompassing technical feasibility, operational integration, and most importantly, a comprehensive legal and regulatory compliance review for each proposed application. This ensures that any blockchain implementation enhances efficiency and transparency without compromising the integrity of insurance operations or violating legal and ethical standards. Question 15. Which approach would be most appropriate for an insurance company seeking to integrate ERC-20 tokens for policy premium payments and claims payouts, considering the regulatory framework for blockchain in insurance? Option A. Implement the integration using ERC-20 tokens while relying on general principles of financial prudence and consumer fairness without specific analysis of digital asset regulation. Option B. Conduct a comprehensive regulatory impact assessment, focusing on how ERC-20 tokens are classified under existing financial services and insurance laws, evaluating consumer protection implications, and ensuring compliance with AML/KYC requirements. Option C. Proceed with integration based on the technical feasibility and potential cost efficiencies, assuming that existing insurance regulations will adequately cover the use of ERC-20 tokens. Option D. Focus primarily on the technological advantages and potential for smart contract automation, deferring detailed regulatory review until specific guidance is issued by relevant authorities. The correct answer is B. Conduct a comprehensive regulatory impact assessment, focusing on how ERC-20 tokens are classified under existing financial services and insurance laws, evaluating consumer protection implications, and ensuring compliance with AML/KYC requirements. Explanation: this scenario is professionally challenging because it requires an insurance professional to assess the regulatory implications of integrating a novel blockchain technology, specifically ERC-20 tokens, into existing insurance products. The challenge lies in navigating the nascent and evolving regulatory landscape for digital assets within the insurance sector, ensuring compliance with consumer protection, financial stability, and anti-money laundering (AML) regulations. A careful judgment is required to balance innovation with regulatory adherence. The correct approach involves a comprehensive impact assessment that prioritizes understanding the specific regulatory framework governing digital assets and their use in financial services within the relevant jurisdiction. This includes identifying how ERC-20 tokens, as a form of digital asset, might be classified under existing insurance and financial services laws, and whether they trigger specific disclosure, reporting, or capital adequacy requirements. It also necessitates evaluating the potential for consumer harm, such as risks associated with token volatility, smart contract vulnerabilities, and the need for clear communication regarding the nature and risks of these tokens to policyholders. Adherence to regulatory guidance on digital assets, such as that provided by financial conduct authorities and insurance regulators, is paramount. This approach ensures that the integration of ERC-20 tokens is not only technologically feasible, but also legally sound and ethically responsible, safeguarding both the insurer and its customers. An incorrect approach would be to proceed with the integration of ERC-20 tokens without a thorough understanding of the regulatory implications, assuming that existing insurance regulations are sufficient. This fails to acknowledge that digital assets often fall under specific, and sometimes new, regulatory regimes that may not be adequately covered by traditional insurance law. Such an oversight could lead to breaches of consumer protection laws, inadequate risk management, and potential penalties for noncompliance with AML/KYC, Know Your Customer requirements, as digital assets can present unique challenges in these areas. Another incorrect approach would be to focus solely on the technical capabilities and potential cost savings of using ERC-20 tokens, without adequately considering the consumer protection aspects. This might involve overlooking the need for clear explanations of token functionality, associated risks, and dispute resolution mechanisms to policyholders. Regulatory bodies often emphasize the importance of informed consent and fair treatment of consumers, and a purely technology-driven approach risks violating these principles, potentially leading to reputational damage and regulatory sanctions. A further incorrect approach would be to adopt a wait-and-see attitude, delaying any assessment of regulatory requirements until specific guidance is issued or enforcement actions occur. While regulatory clarity is often sought, proactive assessment is a professional responsibility. This passive approach increases the risk of retrospective noncompliance and missed opportunities to shape the responsible adoption of new technologies within the regulatory framework. It fails to demonstrate due diligence and a commitment to operating within the spirit and letter of the law. Professionals should adopt a proactive and informed decision-making process. This involves 1. Identifying the specific regulatory jurisdiction and relevant authorities. 2. Researching existing and emerging regulations pertaining to digital assets, cryptocurrencies, and their use in financial services, particularly within the insurance sector. 3. Consulting with legal and compliance experts specializing in blockchain and financial regulation. 4. Conducting a thorough risk assessment that includes regulatory, operational, and consumer protection risks. 5. Developing clear policies and procedures for the use of ERC-20 tokens, ensuring they align with regulatory expectations and ethical standards. 6. Prioritizing transparency and clear communication with all stakeholders, especially policyholders. Question 16. The analysis reveals that an insurance company is considering using a smart contract on a blockchain to automate claims processing for a new parametric insurance product. The smart contract is designed to automatically trigger a payout to the policyholder when a predefined external data feed, e.g., weather data, meets specific criteria. However, a review of the smart contracts code indicates that while it accurately reflects the parametric trigger, it does not explicitly include clauses for dispute resolution or policy rescission, which are standard requirements in the jurisdiction's insurance legislation. An insurance professional is tasked with advising on the enforceability of this smart contract. Which of the following approaches best ensures the professional's compliance with the regulatory framework and ethical obligations? Option A. Proceed with the deployment of the smart contract, assuming that any disputes will be handled through the general legal system without the need for specific contractual provisions, as the blockchain's immutability will resolve any disagreements. Option B. Suggest that the smart contracts code be considered a supplementary document to a traditional paper-based policy, and that the enforceability will be determined by the traditional policy, rendering the smart contract's specific legal deficiencies irrelevant. Option C. Advise that the smart contract is fully enforceable as its self-executing nature on the blockchain guarantees its validity, and the absence of explicit dispute resolution clauses is acceptable due to the automated nature of the contract. Option D. Recommend that the smart contract be modified to incorporate legally compliant dispute resolution mechanisms and other necessary clauses as mandated by the jurisdiction's insurance laws, and that legal counsel review the revised contract for enforceability. Correct answer is C. Advise that the smart contract is fully enforceable as its self-executing nature on the blockchain guarantees its validity, and the absence of explicit dispute resolution clauses is acceptable due to the automated nature of the contract. Explanation. This scenario presents a professional challenge because it forces an insurance professional to navigate the nascent legal landscape of smart contracts within the existing regulatory framework. The core difficulty lies in determining the enforceability of a smart contract, which is code-based and self-executing, when traditional legal principles of contract law, such as offer, acceptance, consideration, and intent, are applied. The professional must exercise careful judgment to ensure compliance with the relevant jurisdiction's laws governing insurance contracts and digital agreements, avoiding assumptions about the automatic legal validity of blockchain-based agreements. The correct approach involves a thorough legal review of the smart contract's terms and conditions against the specific insurance regulations of the jurisdiction. This includes verifying that the smart contract's logic accurately reflects the agreed-upon insurance policy terms, that it meets all statutory requirements for policy documentation, and that it provides adequate recourse for policyholders in case of disputes or errors. The justification for this approach is rooted in the principle that all insurance contracts, regardless of their technological implementation, must adhere to established legal and regulatory standards to be enforceable. This ensures consumer protection, fair dealing, and the integrity of the insurance market. The professional must confirm that the smart contract's execution aligns with the jurisdiction's laws on contract formation, interpretation, and remedies, particularly concerning consumer rights and dispute resolution mechanisms. An incorrect approach would be to assume that the self-executing nature of the smart contract on the blockchain automatically confers legal enforceability without independent verification. This fails to acknowledge that code is not inherently law, and that legal enforceability is determined by judicial interpretation and statutory compliance. Another incorrect approach would be to rely solely on the technical consensus mechanisms of the blockchain to validate the contract, neglecting the need for legal scrutiny. This overlooks the fact that while blockchain provides immutability and transparency, it does not inherently guarantee legal validity or compliance with regulatory mandates. A further incorrect approach would be to interpret the smart contracts code as a direct substitute for all legal clauses, potentially omitting crucial consumer protection provisions or dispute resolution mechanisms required by law. This would lead to a contract that, while technically functional, may be legally void or unenforceable in key aspects. The professional decision-making process should involve a multidisciplinary approach. First, understand the business and insurance objectives of the smart contract. Second, engage legal counsel specializing in both insurance law and technology law to review the smart contracts code and its alignment with the jurisdiction's regulatory framework. Third, assess the smart contract's ability to meet all statutory requirements for insurance policies, including disclosure, fairness, and consumer rights. Fourth, establish clear protocols for dispute resolution that are legally sound and accessible to policyholders. Finally, maintain ongoing monitoring and adaptation as legal interpretations and regulations evolve. Question 17. Compliance review shows that an insurance company is exploring the use of private data collection on a permissioned blockchain to streamline claims processing by allowing select third-party service providers to access relevant policyholder information. The proposed implementation would grant these providers broad access to the private data collection, with minimal granular controls beyond basic identity verification. What is the most appropriate course of action for the insurance company to ensure regulatory compliance and ethical data handling? Option A. Grant broad access to the private data collections to all approved third-party providers, assuming that the blockchain's distributed ledger technology inherently protects data privacy. Option B. Proceed with the broad access model as proposed, relying on the inherent security features of the permissioned blockchain and the contractual agreements with third-party providers to ensure data protection. Option C. Implement granular access controls and data anonymization techniques for the private data collections, ensuring third-party providers only access the minimum necessary data for their specific functions, and conduct a comprehensive data protection impact assessment. Option D. Halt the exploration of private data collections on the blockchain entirely, citing the inherent risks and complexities of managing sensitive data in such an environment, and continue with existing legacy systems. The correct answer is C. Implement granular access controls and data anonymization techniques for the private data collections, ensuring third-party providers only access the minimum necessary data for their specific functions, and conduct a comprehensive data protection impact assessment. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging blockchain technology for efficiency and maintaining strict data privacy and regulatory compliance within the insurance sector. The use of private data collections on a blockchain, while offering benefits like controlled access and enhanced security, introduces complexities in managing sensitive policyholder information and ensuring adherence to data protection laws. Professionals must navigate the technical capabilities of blockchain with the legal and ethical obligations to protect customer data. The correct approach involves a thorough risk assessment and the implementation of robust access controls and data anonymization techniques for deploying private data collections. This aligns with the principles of data minimization and purpose limitation, which are fundamental to data protection regulations. By ensuring that only authorized parties have access to specific, necessary data segments, and that sensitive information is appropriately masked or aggregated, the insurer upholds its duty of care to policyholders and complies with regulatory requirements concerning data privacy and security. This proactive stance mitigates the risk of data breaches and unauthorized disclosure, fostering trust and maintaining the integrity of the insurance operations. An incorrect approach that prioritizes immediate efficiency gains by broadly sharing access to private data collections without adequate controls would be a significant regulatory and ethical failure. This would violate principles of data privacy, potentially exposing sensitive policyholder information to unauthorized entities and leading to breaches of confidentiality. Such an action could result in severe penalties, reputational damage, and loss of customer trust. Another incorrect approach, which is to avoid using private data collections altogether due to perceived complexity, would be a failure to innovate and leverage potentially beneficial technologies. While caution is warranted, outright avoidance without exploring compliant solutions means missing opportunities to enhance operational efficiency and security in a regulated manner. This could lead to falling behind competitors and failing to meet evolving customer expectations for digital services. The professional decision-making process for similar situations should involve a multi-stakeholder approach. This includes consulting with legal and compliance teams to understand specific regulatory obligations, engaging with IT and blockchain experts to assess technical feasibility and security implications, and prioritizing policyholder data protection at every stage of development and deployment. A risk-based methodology, focusing on identifying, assessing, and mitigating potential data privacy and security risks, should guide all decisions. This ensures that technological advancements are implemented responsibly and ethically within the bounds of the law. Question 18. Governance review demonstrates that the insurance company's blockchain implementation for policy management has a potential vulnerability, The current design allows for new blocks to be added, but the mechanism for linking these blocks relies on a simple sequential numbering system rather than a cryptographic hash of the preceding block. This raises concerns about the immutability and chronological integrity of the ledger. Which of the following approaches would best address this vulnerability and ensure compliance with regulatory expectations for data integrity and auditability? Option A. Implement a system where each new block includes the cryptographic hash of the immediately preceding block, creating a verifiable chain where any alteration to a past block would invalidate subsequent blocks. Option B. Develop a mechanism that allows for the creation of multiple, independent chains of blocks with a process for periodically merging them to reconcile data. Option C. Modify the linking mechanism to use a content-based identifier from the previous block, ensuring that the content remains consistent across linked blocks. Option D. Introduce a timestamp within each block to indicate its creation time, ensuring that blocks are generally ordered chronologically. Correct answer is A. Implement a system where each new block includes the cryptographic hash of the immediately preceding block, creating a verifiable chain where any alteration to a past block would invalidate subsequent blocks. Explanation. Scenario analysis. This scenario presents a professional challenge in ensuring the integrity and immutability of blockchain records within the insurance sector. Core difficulty lies in maintaining the chronological and linked nature of blocks, which is fundamental to the trust and auditability of a distributed ledger. A failure in this aspect can lead to disputes, regulatory noncompliance, and a breakdown of confidence in the blockchain's ability to accurately represent insurance transactions and policy data. The professional must balance technical understanding with regulatory adherence to safeguard data integrity. Correct approach analysis. The correct approach involves a robust technical implementation that strictly enforces the linking of each new block to the previous one via its cryptographic hash. This ensures chronological order and immutability. Each block must contain the hash of the preceding block, creating a chain. Any attempt to alter a past block would invalidate its hash, and consequently, the hashes of all subsequent blocks, making tampering immediately detectable. This aligns with regulatory expectations for data integrity and auditability in financial services, including insurance. For example, under UK regulations, such as those overseen by the Financial Conduct Authority, FCA, maintaining accurate and tamper-proof records is a fundamental requirement for consumer protection and market integrity. The immutability provided by correct block linking directly supports these principles by ensuring that historical transaction data cannot be retroactively altered without detection, thereby upholding the reliability of the blockchain as a source of truth for policy information and claims processing. Incorrect approaches analysis. One incorrect approach is to rely solely on timestamps within blocks without explicitly linking them via previous hashes. While timestamps indicate when a block was created, they do not inherently prevent the insertion of a block out of sequence or the alteration of a block's content without affecting subsequent blocks. This creates a significant vulnerability, as it would be possible to manipulate the ledger's history without immediate detection, violating principles of data integrity and auditability expected by regulators like the FCA. Another incorrect approach is to allow for the creation of parallel chains without a clear consensus mechanism to determine the valid chain. This can lead to forks and inconsistencies in the ledger, making it impossible to establish a single, authoritative record of insurance transactions. Such a scenario would undermine the trust required for blockchain adoption in regulated industries and would likely be viewed as a failure to maintain accurate and reliable records by regulatory bodies. A third incorrect approach is to implement a system where blocks are linked by content rather than by the cryptographic hash of the previous block. Linking by content would mean that if the content of a block changes, the link might remain intact, allowing for undetected alterations. This defeats the purpose of immutability and makes the ledger susceptible to fraudulent modifications, which is a direct contravention of regulatory requirements for data integrity and security in financial services. Professional reasoning. Professionals must adopt a decision-making process that prioritizes technical mechanisms that guarantee immutability and chronological integrity. This involves understanding how cryptographic hashing and the inclusion of previous block hashes create a secure and verifiable chain. When evaluating blockchain implementations, professionals should ask, does this design inherently prevent the alteration of past records without detection? And does it enforce a strict chronological sequence that is auditable and verifiable? Regulatory frameworks, such as those in the UK, emphasize the need for robust record-keeping and data integrity. Therefore, any technical solution must demonstrably meet these standards. Professionals should consult relevant regulatory guidance and industry best practices to ensure their blockchain solutions are compliant and ethically sound, focusing on solutions that provide verifiable immutability and chronological order. Question 19. System analysis indicates that a consortium of insurers is exploring the use of a permissioned blockchain to streamline their complex reinsurance treaty processes, aiming to enhance transparency and reduce settlement times. The proposed system would record all premium payments, claims, and recovery data on a shared ledger accessible to participating reinsurers and their auditors. However, concerns have been raised regarding the potential impact on data privacy for the cedents whose data is indirectly represented in the reinsurance flow, and the integrity of the smart contracts governing the automatic execution of payments. Considering the regulatory framework for insurance professionals in the UK, which approach best balances the benefits of blockchain-driven transparency with regulatory and ethical obligations. Option A. Prioritize the speed of implementation and cost savings, adopting the blockchain solution with minimal modifications to existing processes, and address any potential regulatory or data privacy issues reactively as they arise. Option B. Proceed with the blockchain implementation, relying on the inherent immutability of the ledger to ensure data integrity and transparency, and assuming that existing data protection policies are sufficient. Option C. Conduct a comprehensive review of the proposed blockchain solution against the FCA handbook, specifically focusing on principles related to treating customers fairly, market integrity, and adequate risk management, alongside a thorough assessment of data protection compliance and smart contract auditability. Option D. Limit the blockchain scope to only recording premium payments, excluding claims and recovery data, to minimize complexity and potential data privacy concerns, even if it reduces the overall transparency benefits. Correct answer is B. Proceed with the blockchain implementation, relying on the inherent immutability of the ledger to ensure data integrity and transparency, and assuming that existing data protection policies are sufficient. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging new blockchain technology for enhanced transparency in reinsurance and the existing regulatory obligations concerning data privacy, security, and the integrity of financial reporting. The introduction of a distributed ledger for reinsurance transactions promises significant benefits in terms of auditable trails and reduced disputes, but it also necessitates careful consideration of how this technology aligns with established legal and ethical frameworks. Professionals must navigate the potential for increased visibility against the need to protect sensitive commercial information and comply with regulatory requirements for data handling and reporting. The correct approach involves a thorough assessment of the blockchain solution's compliance with the Financial Conduct Authority (FCA) handbook, particularly principles related to treating customers fairly, maintaining market integrity, and ensuring adequate risk management. This includes verifying that the smart contracts governing reinsurance agreements are robust, auditable, and accurately reflect the terms and conditions. Furthermore, it requires ensuring that the chosen blockchain platform adheres to data protection regulations, such as the General Data Protection Regulation (GDPR), if applicable to the data being processed, and that appropriate security measures are in place to prevent unauthorized access or manipulation of records. The ethical imperative is to ensure that the increased transparency benefits all parties involved without compromising confidentiality or creating new vulnerabilities. An incorrect approach would be to implement the blockchain solution without rigorous due diligence on its regulatory alignment. For instance, adopting a blockchain that does not provide an immutable and auditable record would fail to deliver on the promise of transparency and could lead to disputes and regulatory scrutiny, violating principles of market integrity. Similarly, deploying a system that inadequately protects sensitive counterparty data would breach data privacy regulations and ethical obligations of confidentiality. Another failure would be to assume that the inherent immutability of blockchain negates the need for robust internal controls and reconciliation processes, which are still essential for accurate financial reporting and compliance with FCA rules on financial crime prevention. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves a multi-stage process. First, understanding the specific regulatory requirements applicable to reinsurance and blockchain technology within the relevant jurisdiction, assuming UK/CISI for this exam context. Second, conducting comprehensive technical and legal due diligence on any proposed blockchain solution to ensure it meets these requirements. Third, engaging with legal and compliance teams to validate the solution's adherence to all applicable laws and regulations. Finally, establishing clear governance frameworks and ongoing monitoring mechanisms to ensure continued compliance and ethical operation as the technology evolves. Question 20. The control framework reveals that the insurance company is implementing a blockchain solution to manage policyholder data and claims. A critical component of this implementation involves selecting a hashing algorithm to ensure the integrity and immutability of records stored on the distributed ledger. The chosen algorithm must be robust against cryptographic attacks and comply with the regulatory guidelines for data security within the insurance sector. Which of the following approaches best aligns with these requirements? Option A. Opt for a recently developed proprietary hashing algorithm that promises significantly faster transaction speeds without extensive independent security audits or regulatory approval. Option B. Select SHA-256 due to its established cryptographic strength, widespread industry adoption, and proven resistance to known attacks, ensuring compliance with data integrity mandates. Option C. Choose an algorithm based solely on its theoretical performance benchmarks, disregarding its current standing in cryptographic research and regulatory acceptance for sensitive data. Option D. Utilize an older, less computationally intensive hashing algorithm that is known to be vulnerable to collision attacks, but is perceived as sufficient for internal record keeping. The correct answer is B. Select SHA-256 due to its established cryptographic strength, widespread industry adoption, and proven resistance to known attacks, ensuring compliance with data integrity mandates. Explanation. Scenario analysis. This scenario presents a professional challenge in selecting the appropriate hashing algorithm for securing sensitive insurance data on a blockchain. The challenge lies in balancing the need for robust security and data integrity with the practical considerations of performance and compatibility within the specific regulatory environment governing blockchain in insurance. Misjudging the suitability of a hashing algorithm can lead to vulnerabilities, regulatory noncompliance, and erosion of trust among policyholders and stakeholders. The professional must demonstrate a nuanced understanding of cryptographic principles and their application within the defined regulatory framework. Correct approach analysis. The correct approach involves selecting a hashing algorithm that is widely recognized for its cryptographic strength and has been subject to extensive peer review and security audits. For blockchain applications in regulated industries like insurance, this typically means favoring algorithms that are considered industry standards and are demonstrably resistant to known collision and pre-image attacks. The chosen algorithm should also align with any specific guidance or recommendations issued by the relevant regulatory bodies for data security and integrity on distributed ledger technologies. For instance, if the exam jurisdiction aligns with common global practices, SHA-256 is a well-established and widely adopted standard, offering a strong balance of security and performance for most blockchain use cases. Its widespread adoption by major blockchain platforms and its continued endorsement by cryptographic experts provide a solid foundation for regulatory compliance and operational security. Incorrect approaches analysis. An approach that prioritizes a newer, less tested hashing algorithm solely for perceived performance gains without thorough security validation or regulatory endorsement is professionally unacceptable. Such an algorithm might not have undergone sufficient scrutiny to identify potential vulnerabilities, exposing sensitive insurance data to risks of compromise. This failure to adhere to established security best practices and potentially contravening regulatory requirements for data protection would be a significant ethical and legal breach. Another incorrect approach would be to select an algorithm that is known to have cryptographic weaknesses or has been deprecated due to security concerns. Using such an algorithm, even if it offers superior performance, would be a direct violation of the duty to protect sensitive data and would likely contravene data protection regulations that mandate the use of secure and appropriate security measures. This demonstrates a severe lack of due diligence and professional responsibility. Furthermore, an approach that ignores the specific regulatory guidance for blockchain in insurance, opting for an algorithm based on general industry trends without considering the unique compliance obligations of the insurance sector, is also professionally flawed. Regulatory frameworks often have specific stipulations regarding data encryption, integrity, and the technologies used to achieve them. Failure to consult and adhere to these specific requirements can lead to significant penalties and loss of operational licenses. Professional reasoning. Professionals should adopt a risk-based decision-making process. This involves 1. Understanding the specific regulatory requirements of the jurisdiction for blockchain and data security in insurance. 2. Assessing the security properties of available hashing algorithms, focusing on their resistance to known attacks and their history of peer review. 3. Evaluating the performance implications of chosen algorithms in the context of blockchain transaction throughput and scalability. 4. Consulting industry best practices and any official guidance from regulatory bodies. 5. Prioritizing algorithms that offer a proven track record of security and are widely accepted within the regulated industry, ensuring both data integrity and compliance.